Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, today we're going to have a look at the SPY, which is our proxy for the S&P 500. We're also going to have a quick look at the VIX and the PCC. Now, I'm continuing to talk calmly and quietly because my voice is still recovering after being sick for quite some time, and I've got a live stream scheduled for tomorrow, so we're going to just take it nice and easy here today. Now, I've removed the primary and the alternate labeling for our accounts. That's what I'm going to do here now, and I'm just going to say bullish 1, and I'm going to say bullish, if I can spell, 2, and then the bearish count. Okay, because we really are in that situation at the moment where, because we're still internal to these major pivots here, we can still go either way. Okay, now I'll give you my own personal bias, but that's all I can promise it is. I would argue, given some of the bearish sentiment around at the moment, some extremely bearish sentiment in places, some people calling for another GFC, total banking collapse, global financial crisis, so on and so forth. I don't think that's the case at all. I don't think that's what we're going through. It could suck, it could get worse, there's no doubt, but I don't think that's what's happening. The banks are vastly more or better capitalised nowadays than they were back in the GFC, so I don't think we're on the verge of that kind of crisis. And if we were to go back and compare the last week's price action to the weeks of when we had the banking collapses of Bear Stearns and Lehman Brothers back in the GFC, I would argue that the broader index here in the SPY is holding up extremely well, considering the news we've had recently. So in that regard, you could argue there's a lot of strength still here. Now, it could be consolidation before something actually blows up and something terrible happens. That is a possibility. But like I said, I don't think the fear of contagion is as big as it was during the global financial crisis. And I don't think those banks, or the bigger banks in the US, are in the same situation. I think they're far better capitalised nowadays, and there are so many backstops put in place, such as the rush to use the discount window. A lot of things which are in place nowadays to provide that essential liquidity to the banking sector, which were not in place at the time of the global financial crisis. So we're testing the plumbing at the moment to see if all the things we put in place can keep things flowing. I suspect that it will, but there is the chance that it could all go wrong. But anyway, enough chit chat about fundamentals. Let's talk about the chart for a moment. So we're just going to come out and have a look on the weekly time frame here for a minute. Like I said, you just have to put up with me talking a little quietly. My voice is still a little raw and I really didn't want to burn it out. So here we are on a weekly time frame. We had a nice strong push from volume last week. We had a bullish, well, not a bullish candle, but we closed the week positive on where we opened, right? But we stayed internal to this big bearish engulfing candle here. Right, so for the moment this still looks like a flush down and a retracement up in the simplest sense, which is essentially bearish over the short term. However, over the long term, we have come to the 50% retracement of all of the gains made since the COVID low. In March 2020 we came up and then we came back to the 50. Now if we look at more recent price action from the high of 2021, we can see to the low we've come back to the other 50. Okay, so we've gone 50 here to 50 here, and this is where the price has settled since the low. Right, so we're sat between these two major fib levels, and while we've been doing that, we saw, leading into these lows here, we saw divergence on both the MACD and on the RSI between the closes of these weekly lows here, as we came back to the green line here, which is the 250 exponential weekly moving average. Currently below the 60, which is coming down to meters, but not in a hurry, just kind of meandering down. 250 still pointing upwards. So we are basically stuck between or stuck below this major pivot here. Okay, let's just hide this temporarily so we can see 431.73. Right. Below this high and inside of this low, all price moves are internal and therefore considered for the moment. We never assume that we can't be bullish off of a low. We can be, but we are temporarily internal of these two pivots, so we assume a corrective move after an impulsive move down. That was what we were expecting for a long time. That's what we were setting up. If you go back to my video around Christmas, I was saying this looks almost too easy to be true, which was that we'd come back up and we were going to come back down again. Right, now since then one significant thing has changed, which is the breach of this downward trend line. Okay, so we're going to come down to the daily time frame so we can see this a bit clearer now. Now, excuse me, the breach of this downward trend line here to the upside and then a back test of it now. How can I say it? My gut, and it's only my gut, we don't trade off of our gut per se, but the gut feeling I've got is that I want to be bullish above this trend line, putting it simply. Okay, because it is a significant trend line. Taking the all-time high and 1, 2, 3, 4, this is arguably a fifth, because we did still get rejection here, points of contact along this trend line, and then move up through it and back. So on the simplest way of looking at it, from a classical analysis point of view, having breached this trend line, back tested it and moved off of it, while above it I want to be bullish. Now we can look at the move here as a 1 and a 2, probably with a flat pattern here, which means we can look at this as a 1 and a 2. So the level of risk at the moment, depending on which count we adopt, and there are a couple of bullish counts. So from the most recent low, we are 3.26%. Okay, and from the low prior to that, 4.72%. So if we were to believe that this is 1 and this is 2, a move back below that level would likely bring us back below the trend line again, and that could serve as a stop loss for the meantime. It's not ideal. What would be ideal would be to shrink it down to get another move up in 5 and another move back and shrink this down to be the stop instead, which we can do because this could be 1, 2 and 1, 2 again on a smaller time frame. But you are, what can I say, you're getting, well, it's a safer way of doing it, I suppose, but you're more likely to be wrong. That's the way I often talk about it when talking about standard trade setups, STS setups, which is the smaller time frame we get it down to, the smaller the risk, but the more likely you're incorrect. The bigger the time frame we can get it to, the more likely you're right, but the bigger the risk. It's just the way it is. There's no risk-free trade. Now on the bearish side, obviously, we've got the prior pivot here, and then we've got the low, and then a free wave move internal to that prior high, which looks, it could easily be a free wave correction. A, B, and C, right? So this becomes A itself, and this becomes B in a larger WXY. That's what the primary bearish count is. If you were to be uber bearish, you could maybe label this 1 and 2. I'm not sure how exactly you would do it, because if you're saying A, B, 1, 2, if you're talking about a complete shift in scale, you'd have to be part of a larger impulse coming down, and I see no motive wave from the high. I see a bunch of overlapping corrective noise. here, all over the place. So I tend to see this as a series of corrective swings, and this could be a corrective swing within a further corrective swing lower, or it could be bullish. So great. So, you know, what you're saying, Tom, basically what I'm saying is, until you get above this pivot at 431.73, you are still in a downward trend of low, lower high, lower low, lower high, lower low, lower high, lower low. Okay, you're still in that downward trend. If you breach this, that trend is officially over. Now there's a difference between the trend line here, which is the predominant trend resistance that this downward trend has been following to this point, but it is not the trend itself. The trend itself is the series of lower lows and lower highs, and that breaks down once we get back above 431.73. Minor pivot in the meantime here, this reduces the probability of the count being corrective if we move back above that level, because at that point we now have 1, 2, 3, 4 and 5 swings rather than 1, 2, 3. 3 is the most typical corrective form, 5 is the most typically motive. Now we would not have a complete motive structure with 5 here, of course, because we have a bunch of overlapping internal price structures as well, but we could have 1, 2, 1, 2, 3, 4, 3, 4, so on and so forth, and be building a wave 3 extension. We could also have the possibility of 1, A, B, C into 2, and it's a running flat, and now we're off in a 3. Either way, my point is a additional swing beyond the 3 we've had, an additional swing above this minor pivot increases the likelihood that the bullish counts are correct significantly. Now, a breach above this level combined with that means that we've broken the downward trend as well, and at that point it is very much in the bull's court, and it's theirs to lose and theirs to fail, and it's the bears to be bloody careful, because we could be if we are extending, we could be going up violently, and you do not want to be sat on top of that rocket trying to short it. Okay, if we fail at these levels and continue to impulse down and get back below this downward trend line, then we are most likely going to confirm a lower low. It's just more likely the bears are in control at that point. That's it from a classical analysis point of view. So let's have a look at the counts specifically now. We're going to come down to the 4 hour. Just get rid of the volume and the moving averages for the moment, and bring up the bullish count first. The first of the 2 bullish counts. So simply, we've come down in WXYXZ, series of 3 zigzags from the high, bottomed in a primary 2, and from here we've come up in a minor 1, A, B, C into a flat. You can count this as an impulse with this final swing being the 5th, but I quite like this as a flat. No overlap between the 4 and the 3 at minute degree. No overlap between the 4 and the the 4 and the 1 at minute degree. No overlap between the 4 and the 1 at minuet degree. Now I've seen this next bit counted multiple ways. I've seen it counted as an extended 3 within a minute wave 1, where someone's gone 1, 2, 1, 2, 3, 4, 3, 4, so on and so forth. It doesn't seem to behave like an extension to me at all. It seems too squished up, essentially. So I see it as a leading diagonal within a minute 1. So essentially the 5, although long, is shorter than the 3. The 3 is shorter than the 1. The 4 is smaller than the 2, and we get a throw over in the 5th. Now, very common, a throw over in a contracting leading diagonal. And from there we can go 1, 2, 3, 4, 5, A, 1, 2, 3, or A, B, C, B, 1, 2, 3, 4, 5, C, 2. A deep wave 2. Now, it's not ideal, not by any means, because the length of this correction at smaller wave degree, at minute degree, is longer than its parent at minor degree. Right, 39 days as opposed to 21 days. Unusual, not impossible. And the reason it's not impossible is if you are building an extension within a free, within a larger wave degree, everything can get pretty skewed. So for example, if you break out into the free at minute degree and then the free at minuet degree, because you're going to expect another 1 and a 2, that wave degree of 2 degrees smaller can be larger and more powerful than the minor wave 1 of 2 degrees greater. So what I mean is the whole thing can start to expand rather than contract. Now, it is unusual. Normally, parental waves are bigger. So 1, 2, 1, 2, 1, 2, and then you're off. You tend to do something like that. But there is some precedent for this occurring, but it should be considered less likely. So this count is less likely as a result of that. The next thing that makes it a little problematic is the depth of the retracement. So we come back to bear with me, where's the, okay, let's just select this, change it to wave 2. We come back to between the 78.6 and the 89%, and we don't hit either directly. We backtest the 78.6 on the way out of here, back into the golden zone, and the 50 where we find resistance, but we don't have a clear impulse, just another series of overlapping waves. So it's either 1, 2, 1, 2 again, right, or it's corrective. Now, so we've gone a bit deeper than we'd expect, and it's taken longer than we'd expect. So the next thing we've got is a base channel off of these lows. Right. Now, as you can see, taking the low here and the low here and projecting from a previous pivot high, that's our base channel. Typically, if we're going to extend, we may breach the channel, but we will normally not breach it by much. We will go 1, 2, 1, 2, 1, 2, and then we'll launch towards the top of the channel. That's more typical extension behavior. That hasn't happened here, so that's a little point against it as well. Okay, so we're going into a bit more detail than I intended to here, but either way, that's the first bullish count, and like I said, we're no longer calling these primaries or alternates, we're just discussing the options. Second bullish count is that we've had a running flat in the 2, which has back tested the trend. Now, the reason I'm looking at this potentially as a running flat is because we have come back above that bullish trend, that bearish trend I should say. So we brought the wave 1 up to trend. The swing A brought us back inside of it, the swing B brought us back above it, and the C is the back test of it before moving higher. Now, you might say, well, that looks a lot better, Tom. Yeah, I'd argue the way it's played out it looks better, but I'd also argue that this has some serious issues with it as well. For example, a running flat is a rarer structure anyway, and it's very rare in the wave 2 position. So we have to bear that in mind, and also the relative time for it to correct, even for a flat pattern, is extremely long now. This is 1.618 the length. I know it says 2.618, but that's because it's 2 times the measurement of this plus 61.8% of it. Okay, so this is where we would equal it at 2. This is where we would be 61.8% the length of this impulse here. The correction would be rather, this is where it would be 23.6% the length of this correction, and we've gone past the 2618. And we still haven't got a confirmed low, because we haven't seen a clear impulse out of here yet. Right, so it's a very long-winded correction. Flat corrections are more long-winded than sharps. They're sideways corrections in structure. And it could arguably still not be done. So we could move the 5 down and say that this is 3 and this is 4 that's forming now. At that point we have to go 1, 2, 3, 4, 5, 3 into here, 4, 5, 3 into here, 4 and 5. I don't think we can do that. At the moment, it doesn't look right. It overlaps, so I can still get 5 into here, but I can't really get the 4 into here and get a subwave of 5 waves. So it really does have to be a running flat if it's a flat at all. It's just how it looks, because I don't think it's subdividing correctly. So it could be, but it's also less likely. It's not a very likely structure. So now let's have a look at the bearish idea. Now this, honestly, is simpler and cleaner, and therefore you could argue more probable. Now the things I don't like about it are less than what I don't like about the bullish counts, admittedly, but it's still a long way from ideal. So let's look at a zigzag structure of a one-to-one relationship with the C to the A. So this is where we would typically expect to see C come to. C, because it's a third wave, A, B, C, third waves in both motive and corrective structures tend to be more aggressive and more violent, and therefore can reach extension targets far more easily than an extended A or an extended 1, which is an A is a first wave, a C is a third wave. They tend to share some characteristics with their counterparts within a motive wave. Right, so we would more typically see an extension target 123.6 or 1618 is more typical, right, than failing to reach the one-to-one, and that's what we've done here. We've failed to reach that parity. Okay, so that makes it a bit of a suspect zigzag, but still looks better. It still looks better than the bullish alternatives, and we come down here a little cleaner as well. So what we can do here is we can get our 1 and our 2, our 3 and our 4 and our 5, A, B, C, 1, 2, and then we can get 5, 1, 2 again at a smaller degree. Now if this is correct and it's 1, 2, 1, 2, we will roll over prior to this minute degree invalidation here at 407.45, and it will be completely invalid at this minor pivot here if we break that. So I think I've switched that one off. Let's turn it back on here at 418.31. So bearish count is completely wrong at that point. This is not 1212 if we go above 318.31. If we go above 407.45, we invalidate the idea of it being 1212 at minuet degree. Okay. If this is correct, we will roll over into 3-4, 3-4, and we'll be on our way down big time styly. Okay. So you can see the reason I'm going into detail a bit here today is because the market is reflecting how we're feeling about the market. It seems kind of obvious, but it just is. We're split at the moment. We've broken a downward trend and then received some pretty bad, shocking news after doing it. So the springboard effect we may have expected to get from that never arrived. Okay, and the collapse sustained below it never arrived. So we've ended up in a bit of a limbo state where technically the market wants to rally, right? But it doesn't want to do it under the current circumstances. And that leaves us just kind of hanging around in the meantime, waiting for it to make its bloody mind up. So let's now sum up. Now that we've looked at the counts, let's now sum up what we're thinking here. So bring in the primary top 1 into 2. These are supporting the idea of a bullish count. So 1, 2, 1, 2. This idea invalidates at 375.22 on the SPY. A move below this gets rid of the idea of this being a 1-2-1-2 extension. Right. At that point, you're left with only one bullish count that I can see clearly at the moment. There may be others that I haven't spotted, but this is the only alternative I can see at the moment. And this invalidates at the prior low. So let's put that in there now. And this is 34811. Just one pip off. 34811. And we'll put this into the bullish count here. I need to flesh this out with the rest of the stuff prior to it. I'll do that when I've got some time. Okay, save the chart. So that invalidates at 34811 because technically that could be A, B, and C all the way back to here because that's the bottom of 2. Right? Until you get to this point, in which case it's no longer 1 into 2. Right, and then at that point you're left with just your bearish counts. So let's look at that. This is the idea that we've done WX, Y, X, and now we're getting an extended Z wave, or but this is a WX, Y to here, ABC, right? And now we're getting a longer I lost the plot now. Sorry, W X Y. I think it works out the same way actually. Excuse me, I've got myself in a bit of a tiz-was. Let's have a look here. Yes, right. So W X Y into W. At a larger degree, primary degree. This is more bearish, larger WXY. Into X, and then a larger A, B, C for the primary Y, which could be a very deep correction. So we'd be looking for 5 down there in the C. On the smaller degree version of it, which is still the primary not the primary count, but it's a primary bearish interpretation, is that this is a final A, B, C down, the final zigzag down of a series of bigger and bigger zigzags. So we start off with a little one, things don't look too bad, you know, maybe the Fed's only going to fuck around with us for a little while. Then things start to look worse in this zigzag, then things start to look really bad in this final zigzag. So it kind of just continues to get worse and worse each extension as the news and the macro environment deteriorates further and further. That's the bearish idea. So when's this invalidated? In a smaller degree, this is invalidated at 407 spot 41. That breaks the idea of it being a 1-2-1-2. Then we've got the idea of this being a completed ABC. That breaks down when we get to our excuse me, got a XRP is breaking through resistance. Sorry about that, it's just a little alert going off. I have hundreds of alerts set of hundreds of assets that always keep me informed of when stuff's happening. Right, so the next pivot is 418 spot 31. That breaks the idea that this is a completed ABC, but we are still below the major pivot of 431 spot 73, which means this could still be A into B, and this would have to be probably A, B, C like that with a running flat in the B, and it keeps us below 431 spot 73, and then that way we can probably seek out a better relationship between A and C. Still going to fall short by the looks of it unless we extend that C wave of the flat. So there you go, guys. That's all I can do at the moment. Just give you a bunch of levels to look for. So bearish count of 1-2-1-2 breaks down at 407. Completed ABC bearish correction moving lower breaks down at 418 spot 31. All bearish ideas that we currently have break down at 431 spot 73, and then refer back to the bullish counts in the video for their invalidation points. And that's the SPY as I see it. So I'm not gonna, I'll tell you my bias. Because the Elliott wave count is so completely convoluted at the moment, my bias is that stay above that trend line. I'm going to look at it as bullish, and that's going to be my bias. Break back below it. I know this is super duper simple, like all the way back to old school trend lines and resistance. Break below it and back test it to the downside. I'm going to be bearish, and that's it. I have to keep it that simple for myself at the moment, otherwise I'll just get lost in all the analysis. So now let's come over and have a look at the VIX. So we've got our GFC line up here, max at 96.4. We've never seen anything like it since. COVID got close at 85.47. That's the next big event. Our panic line here, this includes multiple, like fear of double dip recession in 2011, for example, the Powell pivot in 2018, taper tantrum earlier than that in 2016, and then you've got everything since has been below that panic line at 48.2. Right, we have seen, rising support in the VIX, right, where the baseline continues to get higher and higher and higher, and we've got this downward resistance, so we're getting compressed over time. Squeezy lemons, getting squeezed into this little gap, and we can see even on the shorter time frame now we're getting squeezed into another compression pattern. Okay, now these things you might say that's a triangle that's going to break higher and that's an impulse. Okay, if I took a bet, and I'm not saying it can't be, I'm just saying if I took a bet every time I saw that pattern that it should break to the upside, I'd be wrong 50% of the time, which tells me that it is not following Elliott wave at all. And I would argue that if you've only got to look at the thing to say, yeah, there's no Elliott wave structure here, we can't do Elliott wave on the VIX. Patterns, compression patterns can break up or down, they can reverse, they can carry on, they don't need to obey any rules. That's my observation of the VIX over years and years, is that we can't rely on it to do any of the things we expect it to do. So in that regard, I would say that if this is the start of the global financial crisis Mark II, and we've already had several banks fail, and although it's not QE, inverted commas, when you allow banks to borrow unlimited sums of money with no upper limit and all they've got to do is put forward government paper as collateral, that's QE. Okay, so whatever the media says, that's bullshit. If you're allowing banks access to infinite liquidity for the meantime, that's QE. Alright, so that's I know it's not the same as the monetary stimulus that we've seen in prior interventions, but it is effectively, practically, for what it provides the banking sector, it is a form of quantitative easing. It's a form of relief. Alright, so we have got that on the cards at the moment, and I would argue that for all of those things happening, the VIX doesn't seem to give a shit. Just doesn't seem bothered. Right, there isn't the fear that one would expect with the beginning of the end of the world. Right, not like we saw the breakout that we saw back in 2008. Okay, now all things have to start from a lower base. I appreciate that, but we've got some stuff we need to break down before we really start to worry. So a whole series of lower highs here, which need to be breached. Then we've got our panic line at 48.2. Beyond there, yeah, we're in trouble at that point. And by then, the count would have cleared up significantly, and it'd be obvious that it was bearish. I think. I say I think because I still don't know. All right, now we've got the PCC. Now, different story here. With PCC, when I've studied previous highs in correlation with the market's lows, has confirmed, but it suggests the bottom's in, and has been for a while now, suggesting that the low is in. We had our extreme event with our intraday candles here at 2.123, and the line chart reading was 1.947. We can see how our 60 exponential moving average, which I use to smooth down all of the noise, because here's the noise. I want to observe it on the day time frame over multiple years, so I need to calm it down. And I will refer to a 5-day, 10-day, and 20-day to get more swings and to see how it's fluctuating over the shorter time frame. But over the longer time frame, we had the 60 trending above the 250. Okay, coming back to it in November 21. And now we've come back to it again now in February 23. The 60 is rolled over, and now the 250 is still trending higher. So when we head back towards complacency and bullishness, the 250 tends to have rolled over completely, with the 60 crossing through it. We're not there yet, but we've had our extreme high. There could be a higher one. It's always possible. But for the moment, we've broken this series of higher lows. So low, higher 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 low, not a higher low. Like just kind of leveling off. We haven't breached this level yet. That would be more telling, I feel. This is analysis which you can't really rely on because this is purely my observation. So, but swing below that 60 exponential low through the 250, you would have broken an even larger pivot of higher lows, of just constantly increasing fear and bearishness, right? And then I think you might well be on your way back down towards complacency and bullishness over the coming years, right? Because this is a long-term structure. We're going back to the GFC through the current day. So the put the call to me still suggests that we've had our bottom. And I've marked it on the SPY chart, extreme VIX and extreme SPY readings where they've peaked, and it does line up nicely with the lows on the SPY. So there you go. So let's come back to the SPY and sum it up. Given everything we've been seeing so far in the macroeconomic environment in the global financial markets, one would have expected to see a lot more damage be done than has occurred so far. Above this resistance line, my gut wants me to be bullish, but I don't have a nice solution for it, or at least not a perfect one. Below this trend line and back tested, I want to be bearish, because then the sequence of lower lows and lower highs is more likely to continue. And we've gone through all of our various counts. So There you go, guys. Thank you very much for joining me on this technical analysis of the SPY. I hope it's been useful to you. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and as always, a huge thank you to my Patreon subscribers. You will be getting this video a day early as always. Thank you so much for your support, and if you're interested in becoming a patron of the Green Star Trading Patreon, then feel free to follow the link in the description box below and sign up. Alright guys, take care of yourselves. I'll be back with you as soon as possible. Bye bye.